Up next, we'll discuss two additional documents. First, the project charter, then the project management plan. We'll provide a quick overview of these documents. Since we'll go into more detail in later chapters, we'll offer extensive explanations later. Let's start with a basic overview of the project charter. The sponsor is responsible for issuing it. It's a formal approval for the project's launch, or in other words, to establish its official status and importance as a document. He also needs to grant authority to the project manager to utilize resources for managing and executing the project. Thus, the project manager receives authorization. Where is this authorization issued? Authorization is granted within the project charter. Therefore, the project charter, think of it as a formal official document. Once endowed with this document's official seal, it confirms the project's recognized status and influence, as well as its rightful authority. Simultaneously, the project manager is officially appointed. It's been officially approved. The sponsor usually kicks it off. So, who's the sponsor? Let me give a simple explanation. So, as a project manager, you need to handle the project. When you can't handle certain things, if things get particularly tricky that are beyond your control, you can look for someone to back you up. The sponsor is the one backing you up. They're the ones that start this project, is responsible for funding the project. A rule is typically filled by a company executive or sometimes by the PMO as the sponsor. Another key document is the project management plan. Project management plan, it consists of two crucial elements. These key aspects must be handled with care. The first outlines what the project aims to achieve, and the second details how to accomplish it. All this information is outlined in the project management plan. He mentioned it outlines how to carry out the project, documents that oversee and manage the project. It also covers reaching the objectives of such a project, detailed objectives outlining the specific tasks to be accomplished. We won't delve into these two documents in depth. In addition to this, when undertaking a project, we must consider one crucial factor. Which factor? The criteria for a project's success. You put in a lot of effort, spent considerable time, and devoted many resources to finish a project. So did it turn out well? Or wasn't it good enough? We need a set of criteria. What defines project success? Particularly schedule. This information also considers quality aspects. These details are crucial for making important judgments. In other words, if your scope has expanded, if tasks outside your scope were undertaken, if costs have run over, resulting in higher expenses, if there have been delays in your schedule, resulting in extended timelines, if the quality meets the required standards, or the quality is just poor, that's something we need to decide, isn't it? In fact, to decide if a project is successful, you might need to consider other factors too. Here's a simple example. As you probably watched a TV show called Journey to the West. In Journey to the West, Tan Jian traveled with Sun Wukong, Zhu Bajie, and Xia Wujing. They traveled west together to retrieve the scriptures. For such a venture, do you think it was successful? I believe many people will have different views, different perspectives. Some will see it as a huge success. Think about it. A frail Tan Sheng, he led a group of martial arts experts to overcome countless challenges and ultimately gain the true scriptures. Quite impressive, don't you think? However, some will argue, honestly, it doesn't seem very successful. How should I say this? In this situation, initially, he claimed it would be done in 3 years to finish this project. In the end, it took 13 years to complete. The project faced significant delays, so how do we evaluate it? In fact, from which angle should we assess it? The criteria might be different, but we need to be aware of this to understand the criteria for success. Let's take a look at something. When we talk about project success criteria, there's actually a very important point. It's about making money. And the concept of profitability, just think about it. If your project had 1 million invested, naturally, it was 10 million. Let's say you invested 10 million and you could make 3 million back next year. You'll earn back 3 million the year after next. In 3 years, you'll make 4 million. So by the third year, right? That's over 3 years. So do we break even? Have we broken even? On paper, it looks like we've broken even. But as we know, 1 million from 10 years ago compared to 1 million today are completely different things. Money is losing its value more and more. So if we consider, we need to calculate this project if it can be profitable. Sometimes we need to consider another factor. We usually also take into account its cost, its value over time. This involves calculating what's known as present value. What's the idea of present value? We only need a basic understanding. What do we mean by understanding it simply? It means taking future money. We need to calculate its present value using a specific method. What's it worth right now? For instance, 3 million next year might only be worth 2.8 million today. 3 million in 2 years could be just 2.6 million. 4 million in 3 years might just be 3.3 million. Once calculations are done, let's determine whether it was a loss or a gain. This illustrates the concept of limits. Here's a chart. You can see here, back in 2021, you put in 8 million. Moving on to 2022, you put in an additional 6 million. In 2023, the earnings were 5 million. In 2024, the profit was 6 million. And by 2025, the profit reached 9 million. These are the figures you can account for. In a situation like this, looking at the year 2020, we determine if there was a profit or a loss. We need to approach it with a specific method. What method should we use? Suppose we use a discount rate of 8%, meaning There's a complex formula involved. You don't really need to know it, since during the PMP exam, it's rarely tested. In fact, it's never tested. You just need to grasp one concept, and that's discounting. After applying this discounting formula, it converts 8 million into present value for this year to its 2020 value to be worth only 4.7 million. Converting 6 million to its 2020 value is around 5.1 million. Once discounting is complete, you'll see that the project we dedicated 2 years to this. We put in 14 million. Then we spent 3 more years generating revenue. We earned roughly, considering this year's figures, it's 1.95 million. This ties back to the concept of net present value, meaning future cash flows discounted back to the present value to evaluate its financial viability, determining its profitability. We will also gather some insights. It's called the investment payback period. What does investment payback period mean? Simply put, it's about when my investment can be recouped. When will I get my money back? There are 2 ways to calculate this. Generally speaking, the simple method is basic addition and subtraction. Right? I invested 14 million. When? To recover the 14 million from my investment. This concerns figuring out when I'll break even. That's one method. There's also an alternative approach, which involves thinking in terms of discounted cash flows, using this discounted cash flow method to determine the current value of my investment, and to identify the point at which I've recouped my initial investment. This defines the investment payback period. Regarding other relevant details, discussing the investment returns, take, for example, the money I've put in, and will I see a return on my investment? And what percentage return should I expect? Calculating using the annual returns divided by the total amount invested to determine the ratio coefficients. As an individual, a higher net present value is always preferable. Don't you think? To start with, it must be greater than 0. 0 indicates that the project is profitable. The larger it gets, the more profit you get. That's the first aspect. The second is concerning the return on investment. The higher, the better. There's also the internal rate of return. What exactly is the internal rate of return? The internal rate of return is defined as a method to calculate it exists. When the net present value hits 0, we can determine the corresponding discount rates. This way, when I determine the net present value as 0, that rate is identified as the internal rate of return. Typically, an internal rate of return is compared to bank interest rates, general, then like inflation rates, as benchmarks for comparison. If it exceeds the current market benchmarks, it indicates that this project could be profitable. Another factor to consider is the investment payback period. The shorter the investment payback period, the better. Isn't that right? Recovering costs earlier is always preferable. We also have the benefit cost ratio to consider. These metrics aren't often tested in exams. We only need a basic understanding of this. Essentially, the net present value should be as high as possible. At the very least, it should be above 0. Should it fall below 0, indicates the project is unprofitable. It's not worth pursuing. On the introduction topic, that's basically the content. If you have further questions, feel free to reach out to us. Join the conversation with us. Thanks for tuning in.